Welcome to Inspiring China, a channel that brings you insight of technology, business, and lifestyle. Do share and subscribe if you like it. Your support is my motivation. At the height of trade tensions between China and the US last year, Larry Fink, CEO of the world's largest asset manager, BlackRock, has said China has the firm's top priority of expansion strategy. I continue to firmly believe China will be one of the biggest opportunities for BlackRock over the long term, both for asset managers and investors. Despite the uncertainty and decoupling of global systems we are seeing today, Mr. Fink said in a letter to the firm's shareholders earlier last year. Along the same theme, another mega asset manager, Vanguard Group, with $6.2 trillion of assets under management, has decided to exit Hong Kong and Japan and move its Asian headquarters to Shanghai. This seemed to resonate with Bridgewater Associates, the $148 billion money manager, which is having a great run in China. Goldman Sachs has announced recently that the China-based company will grow to 600 staff by 2024. As for JP Morgan, US financial conglomerate, is already expanding their footprint in China by 24% in 2021. In addition to technology upgrade, which covers their asset and wealth management business and investment banking operations. The current Morgan Stanley joint venture will also be taken over entirely by the US bank soon. In late 2020, China has lifted the quotas for both the qualified foreign institutional investors, known as QFII, and renminbi QFII, that allows foreign investors to participate in China's financial market. Earlier, the 2 decades-old limitations of foreign ownership in securities, futures, and fund management companies have been removed. Such restriction is designed to allow local companies and financial market to grow and mature, while progressively integrating with the global financial system. Bear in mind, the securities market in modern China has only been set up in the early 90s, and asset management industry was established in the late 90s. According to Nikkei Asia, the growth of China's capital market is the fastest in the world, with commissions paid by Chinese enterprises jumped 36% to $21 billion, an all-time high since the data began being collected in year 2000. China accounts for 70% of fees in the APAC region. It is also predicted that the figure will break the $100 billion mark by 2025. China also has the world's third largest futures market and second largest bond and stock markets. The recent regulatory changes indicate the country's determination to further liberalize and open up the financial market. There are a total of 136 securities firms, 149 futures companies, and 140 public funds companies that access China's stock market value of $10 trillion, second to the US. Amongst these firms, foreign invested companies are 15 in securities, 6 in futures, and 43 in fund management, respectively. The economic growth has been impressive, but not without issues. While commissions have gone up, most securities companies' operating income has been on a downward spin since it hit all-time high in 2015. The contraction is due to declining trading activity that has a direct impact to revenue generation from the brokerage business. Slower IPO activity also contributes to capital market revenue that goes south, according to S&P. China's security industry is more fragmented than the US, but the top 10 players command just 50% of the market share, whereas the US is over 70%. With recent years' market downturn, consolidation seems inevitable. As a result, CITIC, China's largest securities firm, has acquired Guangzhou Securities with $2 billion in early 2020. It has been a long tradition for local securities firms to buy off-the-shelf vendor products, say trading systems. One of the leading software vendors is Hang Seng, which captures 44% market share of securities trading, 85% of fund investment, 90% of insurance investment, 85% of trust investment, 30% of futures trading, 75% of wealth management, and 50% of fund valuation. For the last 12 years, Hang Seng has been ranked as Global Top 100 by IDC FinTech. In 2019, they were ranked 43rd. Amongst China's top 10 listed high-tech firms, Hang Seng was placed number 5 by Wind and Ping An Securities Research, respectively. With market valuation of $10 billion an annual turnover of $5 billion. The level of focus on R&D for Hang Seng is unparalleled. Amongst software vendor companies, the three-tier research capabilities separate into Hang Seng Institute with top software engineers and subject matter experts focus on big data, AI, blockchain, high-performance computing, financial engineering, and advanced research. R&D center that focus on underlying technology, software architecture, and common platform development. And other R&D staff spread across client-facing business departments with emphasis on R&D of product application. Hang Seng invests heavily on R&D to keep their competitive edge in the market, with 2018 annual R&D investment at $2 billion, which constitutes 43% of their revenue. 64% of their employees are of R&D nature, out of the total staff of 7,000. In recent years, the company's gross profit rate has gone up to 95%, whereas return on equity is consistently hovering around a healthy 20%. The company has been labeled as monopoly already, with an extremely high market share in many financial sector. Their product is 2.5 to 8 times their competitors. Many existing customers are not entirely happy about their services for their high customization cost and after-sales service quality. Hang Seng has also been expanding their overseas footprint from acquiring DZH Hong Kong in 2018, which immediately get them 45% of local market share, to entering Singapore market in the same year. In 2019, Hang Seng has set up a joint venture with IHS Market that targets the local bond issuance market. In the contrary, the top 5 local securities firms in China, the investment on IT and IT staff ratio are relatively low as compared with global counterparts. A merely 6% of IT staff is to support these leading brokers in the country. Even though these firms do outsource as well as vendor support and development, the gap is apparent. As for IT investment, East Money Securities has the highest IT investment revenue ratio of 25%. Second place is Ping An Securities with 14% and Orange with 12%. Only a few of the remaining brokers has a double-digit ratio. However, as compared with top global investment firms, the gap is obvious. Goldman Sachs has 25% of their workforce as IT staff, with 40% of their operating expense are spent on IT. Morgan Stanley shares similar traits with 18% IT staff and 40% expenses on IT spending. In addition to leveraging the financial market liberalization by expanding the China footprint and market share, the prospect of M&A in capital market seems a viable option also. Although the local securities industry is fiercely competitive with complex market rules, technology superiority and deep financial industry expertise amongst foreign investment firms do have an upper hand in the relatively young and developing market, especially when China's goal is to continue to open its capital market and financial industry, conform to international rules, and promote global integration. This is where the opportunity for foreign investment and multinational players. Thanks for watching. Stay tuned for more interesting topics and don't forget to leave your comments. See you in the next episode.